Outlier is like a cockpit panel in a jet fighter, right? Everything you're going to need to know is all right here, all in front of you. But how do we simplify that? Outlier 9. So, a double-edged sword, right? On one hand, all the data in the world is fantastic if you know what to do with it. On the other hand, if you don't know what to do with it, it can be an overwhelming amount and it can be a huge distraction, which you don't need. You need to focus in, follow your plan.
More people, there's going to be more competition, but that doesn't mean you can't be successful using data. Still, most of funds nowadays are quant funds, and at least from my own experience, becoming systematic was a lot easier than being discretionary, just because discretion takes years and years and years of intuition, and you'll never really know if you actually have a bulletproof edge. Whereas in data, I can clearly look at my backtests and my own robustness testing and say this has a particular edge.
Here is my backtesting data for Plan M, our most aggressive plan. I have it broken down by sector. I can tell you how many average days I would hold a trade, how many trades were tested over 7,000 in total, the number of wins, the average win, number of losses, average loss, and the win rate. Our expectancy is a formula. It's your average win times your average win percent. I'm sorry, your win rate times your average win percent. And then you subtract out your loss rate and times your average loss percent. That gives you expectancy. Now, we gotta take that one step further, because if you have like 5 trades on, and you have a huge expectancy, that's not really an edge in the market because you don't have enough frequency. So you take your expectancy in percentage terms, and then you multiply that by the total trades that gives you your frequency. That is what outcome means. That's how some of these can have an outcome of over 4,000%, like financials. And some of these can have an outcome of 300%, right? This is 1.86% on the mathematical edge, times the number of frequency is only 174. This has a 282 expectancy, so a whole percentage point higher, and it has 1,400 instances, so nearly 10 times as many. That's why you can have an enormous outcome versus a small outcome. Well, they both have an edge, right? It's frequency times edge.
Now, the second key lesson is slavishly use the models. Once they went 100% systematic in the late 1980s, Simons had a very strict rule. You follow what the model says, no matter how smart or dumb it might seem in the moment. No overrides, no second guessing. Now, to be fair, because I always see this anytime I mention...
Now, I think this is a really important point. One of the traders that I learned from was a market wizard named Larry Haight. He's still around, but he's getting really up there. What Larry Haight taught me specifically was if you don't follow your plan, if you deviate from your plan even by 1 iota, one tiny little, oh, I'm going to take it this time. Oh, I'm not going to just take my stop loss here. Oh, I'm going to fudge it for this reason or another. You never had a plan to begin with. Because the backtest that you proved actually had a positive edge and a huge outcome just got thrown out the window. Because any sort of fudging, any sort of manipulation in the plan is not shown in this data. So your expectancy, your outcome, has nothing to do with what you're doing because you can't follow the rules that you set in order to create this plan. That is so incredibly important. No overrides, no second guessing. If you're going to follow the plan, you got to follow the plan. But there are times when you need to modify the plan, right? Let's say you just came off the back of a losing streak. You need to take a look at your losing trades and you need to say, okay, of these trades, what characteristics happened? For us, in late 2025, we had simultaneously a whole bunch of financials and a whole bunch of energy trades. Every financial trade won, every energy trade lost. So on the outset, it's like, well, I'm never going to trade energy again. Why? Is there actually a flaw in the plan, or was it just a string of bad luck? So one thing I noticed was that the oil price was trending down at that time. So I thought, you know what? Maybe there's a correlation here. If the price of oil is going down, does that mean that my trades should be excluded, or maybe some other indicator added to them while the price of oil is going down for energy trades only? Because the price of oil overrides a lot of things. But what I actually found was while the price of oil is going down, my expectancy on those trades is actually higher. That totally surprised me. So what I found was it wasn't a flaw in the plan. It was just a string of bad luck, which is totally part of having the plan in the first place. Having a plan sometimes means you got a flaw and you got to change it, or sometimes means you had bad luck. You got to build losers into the system.
mentioned this around Jim Simons. He did override his models twice, once during the dot-com bust and once during the quant quake. Now, some people view this as a flaw. They think, hey, he can't stick to his model, so why should we take advice to it? But I would like to challenge any of you to trade a system for 30 years without overriding their model. This is an incredibly daunting task, and most people would have done it hundreds of times, especially because I know a lot of newer systematic traders. Most people override their model within the first week.
Right. And what he's talking about here is being normal, right? If you want to be world-class at anything, you can't be normal. But what's great is that Ovtlyr does a lot of this work for you automatically, right? And because it does it automatically, it makes it a lot easier to be a world-class trader for just 82 cents a day.
So the fact he only did it twice in 30 years tells you everything you need to know about him and his discipline. And this is the hardest lesson really for most traders, because you will be sitting there, your model is telling you to take a trade, and everything in your body is screaming no. Or the model just stays flat and you want to get in, for example. That is the battle of being systematic and algorithmic as a trader. And ultimately, the answer should always be the same. Trust the model.
If you're going to trade using models, you just slavishly use the models. You do whatever the hell it says, no matter how smart or dumb you might think it is at that moment. And that turned out to be a wonderful decision.
Now, lesson 3 is infrastructure investments. While other funds focus solely on strategy, Simons obsessively built world-class computing and execution systems. This allowed his team to focus on research and not fighting with technology limitations. This is something I see so many traders overlook. They spend all the time on strategy development, but their execution is manual, their backtesting is very sloppy, and their infrastructure is held together with tape. Infrastructure itself can be an edge. If your systems execute faster, more reliably, with fewer errors than someone else running the same strategy, ultimately you win. It's not glamorous, but it does definitely matter. Now, some of you might be thinking, well, that's too daunting to have all of this infrastructure. Of course, I'm not saying you need to build your own market-making infrastructure and connect lines directly to the exchange, but having better backtests, automating your own execution so you don't have to be manually placing those trades, so there's less errors, there's less human prone errors as well. That is part of infrastructure as well, which gives you an.
So one thing that we are planning on is called the strategy library inside of Ovtlyr. So, and this doesn't exist yet, but it is something we're building. It's going to be like a one-click button. You're going to see all the strategies that we have proven to have positive expectancy light up on the page. And some of them are going to say an entry day, some are going to say exit day, some are going to say sit in cash and don't F up kind of day. And then we're going to ask for you to help us come up with strategies, but they have to prove. And we at Ovtlyr are going to make a model so that you can prove, mathematically speaking, your strategy works, whatever that case is, right? Because not everybody wants to play trade plan M. Not everybody wants to trade plan ETF, and that's totally fine. But you do need to find a plan that has a positive edge and has positive expectancy. So this is going to be super fun, right? And Fote has a great point right here. Fote says, that's the hardest thing for me. I want to get in and do something, and I need to sit on my hands and trust my time will come. That's what's great about sitting in cash and not effing up, especially now that we have SGOV, SGOV. You're getting paid to sit in cash and not do anything. Is it the most? No, it pays about 4% APY right now. But it allows you to not lose 5% in a single day on something like SoFi. It allows you to not lose 3.5% in a single day on a garbage stock like Netflix. Remember when Netflix only went up? Now Netflix only goes down, right? It allows you to not lose 3% in a single day on something like Coinbase. Right? Sitting in cash is the most defensive play possible when there's nothing else to do. When there's nothing else to do, don't do anything. Sit in cash and not F up means sit in cash and don't screw up your portfolio, right? Let's say you built it up to $100,000. But like Fote's saying, he's really struggling with what to do in the meantime, right? Well, there may be a time where you don't do anything for weeks or months. In fact, talking to Mark Minervini, who won the U.S. Investing Championship twice, he said the luckiest thing that he had was trade set up. Because for him, and the interview is on our channel, just go over to the playlist and go to the Champion Trader series. For him, he said that he's just going to sit in cash the entire year if nothing sets up. And that's how you need to maintain your mental edge as well. Like when there's nothing to do, like right now, at the time of this recording, I haven't traded in a few weeks, and I might not trade it in a few weeks in the future. I'm totally cool with that because I'm earning interest in SGOV. I'm not effing up my portfolio because if like I said, with Fote, he's built it up to $100,000. And then he gets that temptation of, oh man, I really want to do something. Oh no, I want to do something. And then when he finally has the opportunity to trade, it's now down at 85,000. Right? So he's negative compounded against himself. And that's hard. Dude, I get it. But remember, Fote, if you want to be successful at trading, you can't be normal. For everybody watching, if you want to be successful at trading, you can't be normal. Because being normal is what happens to 90% of traders who blow up 90% of their accounts in the first 90 days of trading. We don't want that for you. We want you to be an outlier.
Explore new markets. Simon's had a quote that I love. If it's publicly traded, liquid, and amendable to modeling, we trade it. Here's the full context around that saying.
Starting in those areas that I mentioned, currencies, financial instruments, gradually moving to stocks, and finally to anything that moved. Well, it had to be tradable, had to be liquid. Was always liquid. But
now, unlike discretionary traders who get emotionally attached to one specific market, Renaissance Technologies only cared about one thing. Do we have alpha?
Exactly. Do not look at any situation, any market, and say, oh, it's all the same, right? It's all the same. No, in fact, Deep Thought mentioned this earlier about right here, except healthcare. We don't trade that guy. F that guy. Exactly. Because healthcare actually had negative expectancy. So there are not 11 sectors on here. There are only 10 because every single way that we put healthcare into our plan, it brought it down. It made it worse. Why? Because instances like this can happen and did happen. VKTX. There's a healthcare stock where it happened today. I saw the headline, but I don't remember what stock it was. If you remember, tell me. Overnight, they had news come out that nobody expected about their GLP weight loss drug. Overnight, the stock gapped down 40%. This was not an earnings announcement. This was an unexpected news announcement. And because this sector can have unexpected news announcements happen quite a lot, you can get absolutely monkey hammered in VO. That's what I'm seeing in the chat. You can get absolutely monkey hammered by doing nothing, right? Right here. In VO, you woke up this morning, you're down 15%. They had news come out. What was the news? Obesity drug trial fell short. 23% weight loss versus... Okay, let's break. This is the exact reason. Hear me out. You want to know why you should avoid healthcare at all costs? This is exactly why. Novo Nordisk's obesity drug trial fell short. It showed a 23% weight loss versus Eli Lilly's 25%. So the stock fell 15% at that moment. The results were great, but not great enough. 15% gone. Dude, headline risk.
For here. If it had enough data and liquidity, they would trade it. And this is something I've applied in my own trading. I trade futures, cryptos, equities. I really don't care what the market is. I care about whether my data tells me there's an edge that I can exploit. And the more diversification you have, the better you can take advantage of what is considered the holy grail in trading. The more low correlation strategies you run, the better, because you get higher risk adjusted returns. If you need more context about that, feel free to check out my video about the holy grail in trading, which goes over how Ray Dalio, one of the biggest hedge fund managers in the world, explains it. Now, lesson number 5.
This is also super important, large sample sizes. So going back to this, right? If we only had, let's say, 20 trades in each sector, this is not a robust backtest. Not a robust backtest. Because we don't have enough frequency to make sure that this actually works. So we have hundreds in all instances, multiple hundreds in all instances, except for Staples. For some reason, there wasn't a lot of Staples. Probably because Staples is a defensive sector and it only goes up. Well, I shouldn't say only. It likes to perform best when the market is moving down. But even Staples has a huge positive edge, right? And you're not looking for thousands of percents on your expectancy. You're just looking for a positive edge. Because if you had, let's say you had a quarter, right? And for every time you flipped it, let's use actual numbers here. For every time you flipped it, if it lands on heads, you win $8. If it lands on tails, you lose $4. So there's 2 to 1 right there. And you can flip that quarter and 54% of the time it's going to win. So you have a 2 to 1 risk to return and it's going to land on heads more than 50% of the time. You need to flip that until your thumb breaks off of your hand because you have flipped it so many times. Now, understanding you're not going to win every time. In fact, you may lose 10 times in a row. Because just like winning is an unavoidable consequence of trading, losing is an unavoidable consequence in trading. So you have to embrace the losses and understand that when you have an edge, all you got to do is just throw more occurrences at that edge.
Is large sample size. Data wasn't just vital for discovering alpha, it was crucial for verification because Simons understood something that most traders ignore, the law of large numbers. With sufficient samples, results converge to the true expected value. Here's him quickly explaining it.
You're looking for anomalies. You're looking for, like you said, the efficient market hypothesis.
But any one anomaly might be just a random thing. So is the secret here to just look at multiple strange anomalies and see when they align?
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not. You can see an anomaly that's persisted for a sufficiently long time so that the probability of it being random is not high.
This is why backtesting on 20 trades means nothing. This is why if you
I totally agree.
say, it worked last week means absolutely nothing. You need large sample sizes to know if you're seeing something that is actually real or just noise. And this is one of the biggest mistakes I see traders make. They test a strategy on a tiny sample. They see good results, they go live, and then they wonder.
And this recency, this hindsight bias is what's taken out people in Palantir. Oh, remember when Palantir was so great a few months ago? So if I buy the dip, then it's just going to be so great again, right? As it's fallen by how much? Let me remove all my notes here. As Palantir has fallen from its all-time highs to now, down 40%. Remember when Robinhood and SoFi only went up, right? That hindsight bias. Now Robinhood is down over 40% since the sell signal and outlier came through. Let me show you that real quick. All right. And I would imagine the 82 cents a day that you would have paid for outlier for the annual pass is definitely worth it when you see 43% of your investment evaporate. Right? You cannot look at a stock at any point in time and say, well, it did this in the past. It was real good then. It's going to be real good now, without a sufficient number of data, without a sufficient sample size. Because yeah, of course, anybody can look back at a stock at any point in time and be like, oh, look, it went up. How about Open Door? Oh, look, it went up bigly in September, August timeframe. It's going to do it again, right? As it's down 20% since the sell signal that came through.
Why it falls apart. You just didn't have enough data to actually verify. And most of the time.
And yes, Junior, that was. Thank you. I forget that button's there. Thank you so much.
People put way too much significance on results that aren't actually significant. For example, if you do a backtest on 20 trades and it says you're going to do 100% returns each year, I can already tell you that's not going to happen. You have 20 trades, it's not enough to actually say if that's truly predictive. If you had 2,000, 5,000 trades and you had a solid backtesting infrastructure and then it said that same result, that's something I could more believe, but obviously you'd still see how it works on live.